Good evening, everyone, and welcome to the first uh, webinar of our Economic Education Series of 2021. We thank you all for joining us this evening. We have a power-packed session for the next hour and a half, filled with lots of information for all of you on reducing debt and avoiding fraud or avoiding becoming a victim of fraud. Before we begin, I just want to go over a few housekeeping items with you, just so that you'll know. So this is a webinar format, so all participants will be muted. The chat feature is also disabled. We will have a question and answer segment. Tonight's webinar is broken up into two segments. I did not introduce myself. Let me go back and do that. My name is Jillian Walker, and I am a committee member at the Torch of Wisdom for our economic education series. I apologize. Okay, so back to the housekeeping. The Q&A feature is available on your screen. So if you have any questions throughout, please feel free to type them in, and we will address them at the end of each segment. At the end of the presentation tonight, everyone will be sent a survey, and we ask that you please provide some feedback and answer the questions so that we can make sure that we're providing the best information to you all that's the most helpful. Our agenda for this evening. In a moment, I will introduce to you the president of the Torch of Wisdom Foundation, Ms. Beverly Allen, and that will be followed by our two segments. The first will be on debt reduction, and we have three dynamic speakers, dynamic panelists, and the second will be on fraud prevention with our representative from the Better Business Bureau. Each segment, again, is followed by a question and answer segment. And we'll wrap up the evening with some closing remarks from the president of the Southfield Alumnae chapter of Delta Sigma Theta Sorority Incorporated and the vice president of Fifth Third Bank. So without further ado, I would like to introduce to you all Ms. Beverly Allen, the president of the Torch of Wisdom Foundation.
Thank you, Jillian, and good evening to everyone. Again, I am Beverly Allen. I'm the chairperson and president of the Torch of Wisdom Foundation. And on behalf of our board of directors, I bring you greetings and welcome you to this important and timely discussion about navigating your way to financial freedom. Now, we know now more than ever in the midst of COVID, it is critical for our communities to be strengthened financially. And for so many of us, taking that step to debt reduction is the first step. So in advance, I would like to thank all of our panelists for partnering with us to share their wealth of knowledge, experience, and information on debt reduction and fraud prevention, and just speaking from their experience. We would also like to acknowledge and thank our partners at Fifth Third Bank for your support and your continued investment into the financial strength of our community. And certainly last but not least is we want to thank all of our attendees tonight who found it important enough and interesting enough and relevant enough for your lives to be here. And I believe you will not be disappointed. So without further ado, I will turn the program over to the capable hands of Jillian Walker so we can get started.
Thank you. Okay, so we're moving on into our first segment on debt reduction. Our three panelists for this evening are Ms. Kanise James, a consultant from Kingdom Financial Literacy Services. Kanise Michelle James is a Detroit native. She received her Bachelor of Arts degree in Mass Communications from Shaw University in Raleigh, North Carolina in 1999. Kanise saw a need to educate inner city youth on the matters of personal finance. Therefore, Kingdom Financial Literacy Service was birthed in 2018. This continued passion led to Kanise becoming a financial consultant for Farmington, Michigan-based Financial Education Services in 2019. This opportunity allowed her to model entrepreneurship for her sons and to create an additional income stream for her household. It is Kanise's passion to expose and educate disenfranchised inner city youth about financial literacy and help everyday people who encounter obstacles with their finances achieve or regain personal financial success by assisting them to build their credit, qualify for lower interest rates, and educate them regarding the matters of personal finance. We also have Mr. Reginald Gilson. He serves as the financial center manager for Fifth Third Bank's Detroit East Side location. Along with his day-to-day responsibilities, Reginald has a demonstrated history in the establishing, maintaining, and strengthening of community partnerships through various initiatives. He has nearly 15 years of banking experience and nearly 25 years in the financial services industry. Reginald is a very engaged member of Fifth Third's African American Business Resource Group, the Osborne Business Association, and is co-chairperson of the Wayne County CRA Association. He's an active partner with Samaritas, Meriters Inn, Operation Hope, Michigan Department of Health and Human Services, Detroit Land Bank, and Detroit Economic Growth Corporation, among many other organizations, which has included providing financial literacy and empowerment courses to staff and/or participants and other services. Our third panelist is Mr. Jamel Parks. Jamel currently serves as a personal banker for over 3 years at the Fifth Third branch in the city of Flat Rock, where he develops and implements individualized programs to help individuals and businesses achieve their short and long-term financial goals. He has received multiple awards over his career for successfully achieving and exceeding production and quality goals. He has found success in multiple areas of the financial industry with over 11 years of financial experience. Jamel's work experience encompassed being a CUNA certified financial counselor and an underwriter for City Mortgage and ProMedica Federal Credit Union. Please welcome our 3 panelists this evening. Kanise, are you able to share your screen? I'm going to stop sharing mine. And you are on mute. Awesome.
Can you see my screen? Hang on.
Yep.
Okay, let me just try to expand it a little bit. Share. Oh no. Done. Okay, we'll just go with this because it's not, okay, present. There we are. Super excited about this opportunity to talk to you guys today about financial literacy. And I just want to thank Madam President for inviting me. Today, we're going to talk a little bit about managing debt, budgeting, your credit report, the 3 credit bureaus, how your credit score is calculated, trade lines, the storehouse principle, and also creating a mindset and discipline for handling your finances. There's over 63 million Americans who have a credit score of 599 or less. Poor credit can fill people with anxiety, embarrassment, frustration, and fear. Oftentimes when you go into a car dealership and they run your credit report, you're anxiously waiting on them to tell you you've either been approved or you're not approved. But with good credit, it makes it easier to qualify for new homes, new cars, lower interest rates on credit cards. You won't have to provide security deposits when you're, going to get DTE or things of that nature. When your credit is good, If you go to apply for a cell phone, they won't require you to put down a deposit of that nature. How to reduce your budget during uncertain times. One of the things that you can do is assess your income. No one was prepared for the global pandemic that happened in 2019 and 2020 and what we're experiencing now. I have several friends and business partners who had gone into business with the understanding that perhaps, they were going to be successful in their business venture, either through their daycare center or whatever business that they created. But, when the pandemic hit, they needed to actually adjust their budget. So they would have to look at their income and review their expenses and determine what they could do to generate income or, not be in the red with their business. So I think it's important that when you're adjusting your budget, you also have to look at your spending and you have to find a way to trim your bills. While we're home, we're spending more money on things like groceries and household essentials, and we're spending less money on things like transportation and entertainment. So that's definitely a way to reduce your budget, okay? Tracking your income, which includes like your mortgage, your rent payments, auto loans, student loans, insurance, and utility bills, is definitely a way that you can reduce your spending during a global pandemic. Another way is to use your credit wisely. Make sure you're not making impulsive purchases, and also monitor the interest rates when you're making these purchases. It's important that we also keep a savings and have an emergency fund on hand so that we have that financial cushion in the event that we need it, okay? Debt. The term debt means an obligation or an agreement that you've gone into with a party where you're borrowing money and you agree to pay that money back. There's two types of debt. There's good debt and bad debt, but all debt is not created equal. For an example, your mortgage and your student loans would be determined as good debt. Bad debt would be things that carry high interest rates and don't generate any income or equity. It's very important that we keep an emergency fund for things that unexpected that may occur, and also have, cash on hand in the home in case we incur, some unexpected expenses. The credit report. I want to talk about the 3 credit bureaus so everyone knows that there's Experian, Equifax, and TransUnion. These are nonprofit agencies and they get paid to put negative items on your credit report, which most people don't know. They're also, they also basically will give you the ability to dispute any negative, erroneous, or obsolete items that you see that appear on your credit report, such as late payments, tax liens, bankruptcies, and outstanding balances. Oftentimes, people will have like collection accounts that appear on their credit report. And when they do, if you dispute those items, they do have to be removed if they haven't been verified. So for an example, if you go to the doctor and you owe, just say Henry Ford Hospital, for an example, $1,000 for maybe a medical procedure that you had, what they don't tell you is that bill is between yourself and Henry Ford Hospital and not the 3 credit bureaus. So when you dispute that item, the collection agency will have to remove that because they don't have permission to put those items on your credit report. The credit bureaus basically generate a score, and we're going to go over how your score is calculated. There are 5 factors. One is payment history. 35% of your credit score is determined by the payment history. So it's imperative that you pay your bills on time each month. 30% is amount owed. For example, you should never exceed 30% of utilization. So if your credit card limit is $1,000, you should never be exceeding $300 on that credit card. If you exceed 30% utilization, it brings your score down. And prior to me getting into financial literacy, I didn't know that. 15% of your score is based on the length of credit history. So you should never be closing accounts that you have. So say for an example, maybe you opened up, a gas card many years ago. Like myself, I opened up a gas card when I was in college, and I've had that gas card for 20 years. I don't use it very often, but because I've had it for 20 years, it's improving my credit score because I've had it for a length of time. 10% is based on new credit inquiries. So if you're going to different places and they're pulling your credit report, that's considered an inquiry. So if you have too many inquiries, it automatically brings your credit score down. 10% is based on the types of credit. So you have installment versus revolving. So installment is considered like a credit card. Revolving is considered like a mortgage or a car payment that you would have for an extended period of time. 6 tips to boost your score. Number 1, pay your bills on time. You also should pay down smaller debts first. So I know we're honing in on debt reduction. So oftentimes you may have a number of bills, but it's imperative that you work on it like a snowball effect, where you would pay down the lowest debt first. And then the funds that you were paying down that debt, once you pay it off, you would apply it to the next lowest debt that you have. There's a book by Dave Ramsey that I read that really talks a lot about debt reduction. So I would definitely recommend that you guys, write that down. Dave Ramsey, he has an excellent process called the snowball where you can pay down your debt. Avoid new credit applications. Only apply for credit cards that are necessary, and you definitely have to use your credit responsibly. Limit your time for shopping for loans. So you shouldn't make inquiries within a 45-day period of time, like multiple inquiries, because that will definitely bring your score down. Avoid shifting debt to other accounts. So oftentimes people will have a debt with one company and then they would apply for another card with a lower interest rate, and they would transfer the debt from company A to company B. You should avoid that. And report any errors that are on your credit report. If there's any errors on your report, you should definitely be reporting them. One of the things that I want to make mention of is oftentimes people go through things like divorce or the loss of a spouse or the loss of a job, and it makes it necessary for us to adjust our budget when things like that happens. Or if you are a business owner and you lose a contract that is bringing in a lot of money, you definitely have to adjust your budget. And we don't plan for that. So when you're making large purchases, like say for an example, you're planning to purchase a home, I would recommend that you purchase that home based on one income opposed to basing it on 2 incomes, because what happens is you become house poor, or if one person loses their job, then you're struggling to try to make ends meet to pay that mortgage. So one of the things that my husband and I did was we did base, when we were looking to purchase our home about 10 years ago, we based our purchase on one person's income. So in the event that one person loses their job, you're still able, like I say, to make the bills. How to stay on track. One of the ways that I stay on track is I make a list and I focus on one debt at a time. By doing this, I was able to utilize the platform that I offer with my business to pay off all of my student loan debt. And that wasn't an easy feat, but I was able to accomplish it by making a list and just knocking down one student loan at a time. Be especially wary of scams. We have to be vigilant in the times that we live in because there are predators, they're on social media, they're jumping in your inbox, basically saying, okay, we're offering $50,000 in grants. You have to be vigilant because a lot of that, if it's too good to be true, it's a scam. I know recently one of the news reporters was scammed. A company contacted him, basically said, you know, we have your money. It was put in our account by mistake. So you need to give us your account information. And they basically siphoned all of his money out of the account. So we definitely have to be vigilant and weary of scams, especially with our elderly parents and grandparents. Avoid high rates of avoid high rate loans. So if the loan is 24%, 15%, you need to avoid getting high interest rates on loans. And don't sell your stock, okay? Right now, we know the stock market, it's starting to rebound, but when the pandemic first happened, there were people, I know they were contacting me, asking me if I wanted to, sell my stock or take out, draw down my money because of the market. Definitely leave it in there. We've seen these type of times before, and the stock market will rebound. Evaluate your spending, make sure it's a need and not a want, and think long term because this too shall pass. And we know youth financial literacy is important. We definitely need to talk to our young people about making and building strong money habits. We need to, number one, set the stage for our children, set up a bank account for them. When grandma gives them allowance, make them, put a little bit in church, make them deposit it into some of it into their bank accounts. And we need to teach them how to make good financial goals, set savings goals with our children, and allow our children to, if they want that one thing, make them put some money aside, for that, and hold them accountable for achieving that goal. And then we'll help them a little bit, but we're not just going to give them a handout. We want to teach good financial principles to our children. We also want to teach them about smart spending and buyer behavior and not buying impulsively. And, with the services that I offer, we have a budgeting, a credit restoration, credit builder, credit attorney, credit monitoring, will and trust, financial lockbox. These are just some of the services that are life-changing that we offer. And this is how to contact me. Thank you very much for this opportunity and this time.
Thank you, Kanise, for that wonderful information. Again, if anyone has any questions, please feel free to put them in the chat and we'll address them at the end of our segment. Okay. Jamel and Reginald, you guys are up next. Let me share my screen as well. Okay.
All right, awesome. Can you hear me?
Yes.
Awesome. Okay, well, as mentioned, my name is Reginald Gilson, and I am the Financial Center Manager of one of the Fifth Third branch locations, the Gratiot State Fair location in the wonderful city of Detroit. I've been with Fifth Third, hard to keep track. I think I've been there probably about 9 years, roughly 15 years in the banking industry, and a little bit more than 25 years in the financial services industry. And I'm only 30 years old, if you believe that. I know you say the math doesn't add up, but in my mind, that's what we're going to go with. But today we're going to present, both Jamel and I, we're going to present to you one of the modules of what we call Empower You. Empower You is basically it's like a curriculum of financial education classes that Fifth Third offers that covers every area of financial matters. It was developed by experts for the sole purpose of presenting helpful financial information to those in need. Just a brief, just a little bit of information about Fifth Third for those of you who may not know. We've been around since the late 1800s. Our name is the combination of two banks that merged in Ohio, the Fifth National Bank and also the Third National Bank, which is how we got our name. We do specialize in pretty much anything financially related, any service that you're in need of. And so with the module that we're going to go through today, we kind of thought it was best to not necessarily just focus directly on debt reduction itself. This module that we're going to go through, which is called Financial Checkup, is going to actually touch on just about every area related to financial matters, because it's kind of a sky view or more of an overview, but we thought it might be important to just talk about this, bring up this module today. And we do have others that we can schedule if you want to take a deeper dive. And I like saying that when it comes to the modules that we present, that normally one of three things should happen. Either you'll pick up some information that you didn't know, you'll maybe get some things reinforced that maybe you already did know, or it'll be a combination of both, which, most times that's what it is. And so I know we're not in an environment, normally I would, ask and kind of get some participation from you, but I like when it comes to presenting this module, just the name itself, Financial Checkup. Just think about this to yourselves. What do those two words bring to mind, financial and checkup? Well, financial, of course, will kind of bring to mind the fact of dealing with with money matters. And checkup, I like that because it really gives a really good illustration. I'm sure most of you or a lot of you probably think about a doctor's visit. And with doctor's visits, they're very important because especially, it's a good idea to not just go to the doctor only when there's an issue. You want to go, for checkups, because the idea of a checkup, you're going for the purpose of, trying to do preventative care, trying to catch issues before they turn to major issues. And so with this module, that's kind of how it's designed around, being able to, kind of help you to address issues or address items before they become major issues. If I could have you to turn to the next slide, please. And so we're going to just start by just kind of throwing out a couple of questions, and again, just something for you to think about to yourselves, and if you kind of have any idea of what the answers are. But the first question is, what percentage of Americans have a monthly budget? We'll go ahead and flip to the next slide, which actually tells us that roughly 40% according to one survey or one poll, 40% of Americans actually have a monthly budget. I kind of think maybe it might be a little bit less than that, but according to this survey, that's what it said. And we are going to touch on budgeting just briefly as a part of our presentation today. But just thinking about the numbers that I gave, think about where it is that you fit into that. A lot of people don't, they have the idea that having a budget is not important. And I have to admit that, many moons ago, before getting into the financial services industry, I was kind of one of those people. You get the idea like, okay, I know how to manage my money, and, there's no need to, keep track. But you would be surprised, and it's really eye-opening once you do start getting into budgeting, just to see where your money goes. But seeing where it goes can help you to put together a better plan for it. So, but again, we'll touch on that just briefly today. Next slide, please. So the next question I have is, what percentage of workers are confident about having enough money for a comfortable retirement? And the comfortable is the key word. Let me have you flip to the next slide, please. And according to another survey, the estimate is about 67%. So 7 in 10 people, the survey goes, that says that they are comfortable or that they're confident that they'll have a comfortable retirement. I tend to think that because of what COVID has done and what it's brought to our nation, that number is probably a lot less. As Kanise mentioned, this was something that, many people didn't plan for nor were expecting. But to me, it just kind of really drives home the point that learning how to plan your finances is even more important. So again, planning is a key aspect. And again, we'll touch on that just briefly in a moment. Next slide, please. So the final question is, what percentage of Americans list money as their number one stressor or number one source of stress? And let's go ahead and go to the next slide to see the answer. And according to Capital One CreditWise survey, it looks like 73% of Americans list money as their number one source of stress. And again, I would think that, because this survey was taken before the COVID pandemic. So I'm sure that the number is certainly higher. And when you think about how important money is, and when you think about the fact that money can cause stress, stress can, of course, cause health issues, and, which could lead to, deeper money issues. So the issue of money and understanding it is important. And I'm sure, if you were a person who didn't see that before COVID, I think you probably definitely see it now. The area of money controls so many areas. In fact, there was another survey done that said that money is like the number one reason for the majority of most divorces that take place in our country. So again, having an understanding of how it works is essential, and really the word essential is not a strong enough word. Let's go ahead and move to the next slide, please. So when it comes to your finances, basically you can break them down into three categories. And again, this is just going to kind of be a sky view or an overview of these components. But pretty much anything or any financial activity falls into three categories, as we see here, and that's to plan, to protect, and to grow. So of course, if we look at these one by one, we can kind of look for ways to make your finances into something that's more manageable and that's doable and also trackable. So let's go ahead and take a look at that and just kind of talk through some of these items just briefly. So next slide, please. So the first section, or the first area of breakdown that we'll look at, is the planning section. And I love this particular illustration, because to me, it just, to me, illustrations are big, because it kind of helps to drive home a point. And with the slide cover that we have here, it's a picture of a map. And, that's really essential, because you think about that concept of deciding that you want to, take a trip somewhere. Well, aside from deciding where your destination is going to be, it's also equally important to know where you are. So that way you can, then map out a way to get to where you're trying to get to, from your point A to whatever your point B is. And so planning kind of takes on that, that mindset when it comes to finances. Some of you may have heard this saying. It's a saying I've held on to for many years since I've heard it. But there's a saying that goes, if you fail to plan, then you plan to fail. Well, that same motto certainly applies when it comes to the area of money. And so again, it's important to plan, just like planning that road trip. It's important to plan or map out your finances, where you are versus where you want to get to. So again, we'll talk about a few items just briefly that's related to that. Next slide, please. So when it comes to the areas, this area of plan, there's a couple of items that kind of ties into it, and it centers around planning and anticipating. So it starts with you listing what goals you have, and considering some life events that may come up, or some things that maybe you're shooting for, if it's marriage or having children, or eventually retirement. So it's important to have the right planning in place. And it starts with writing down what your goals are. Again, something that people take for granted and they think is no big deal, but there was a survey that was done that shows that people, or a study that was done that shows that for people who write out their goals, they're more than 1.5 times likely to achieve those goals, because something about writing it down just kind of helps with ingraining it in you. And then, if that's there, then, it'll help to hopefully drive you more towards achieving what those goals are. So very important to write your goals out. Next slide, please. And so here we're just going to talk briefly, and again, we have a separate module for this that we could, arrange to cover at a later date. But again, just kind of a sky view overview type. But what this slide talks about, or what it shows, are the basic elements of any budget, and it breaks down into 3 primary areas. Your income, and again, that as you see here, it deals with listing all of your income, all sources. Savings and investing, which will also tie into retirement, as well as emergency savings or any other savings goals that you may have. And then, of course, your expenses, which will tie into your utilities, or just food, clothing, and of course all the essentials. And a budget is very important. As I mentioned earlier, there, many people kind of have the idea that a budget is not important, but it is. And I'm not sure of how many of you have heard of Dave Ramsey. He's like a, financial guru. And I love what he had to say about money. And when it comes to a budget, he says that having a budget is you having a plan for every dollar that you're going to get before you get it. And that's very important. I can certainly speak to that from, as being in banking for as long as I have, because I've talked to customers throughout my career that they were expecting maybe an inheritance, or I've even dealt with a couple of lotto or lottery winners that have won big pots and these things, and there are times where pretty much in every case I would plead with them, hey, listen, let's put a plan together for this money before you get it, because if you wait until you get it, it's going to be too late. And there were some who listened to me, most didn't. And I can tell you stories of individuals I've dealt with that had large sums. In fact, I can tell you of one person that had over $1 million, and that person was totally broke in probably less than 6 months, and there is just no reason for that. But had that person listened and we mapped out a plan, then that money would have been working for that individual. And we see it all the time. We have the idea that more money equals fixing your problems, but that's not the case, because if you don't know how to manage what you have, starting with what you have, more money is not going to fix it. So and we can tell that by many stars and basketball players and others we can think of who are millionaires but then had to file bankruptcy. And again, just something that just should not take place. So, but again, the elements of a budget are shown here, and it's important with a budget to list everything. Don't leave anything out. Even if there are habits or forms of entertainment that you like, if going to the movies, or if the casinos are your thing, I hope not, but if they are, having that as a part of your budget, it'll be really eye-opening to see, once you list everything out, just where your money goes. But seeing it listed out will allow you to make the necessary changes, where you can say, okay, you know what, I have too much money going here. I'm saying I'm broke all the time, where I could free up, cut down on, this expense, or cut down on this hobby I like to do, or whatever it is. And just, and once you do that, it'll be really, really eye-opening for you. But then it'll allow you to make the necessary changes to it. And, and with a budget, it's important to know that it's something that you have to always keep updated. But again, this is something we can look into deeper at a later date. Next slide, please. The last slide that I'll be covering before I turn it over to my colleague Jamel is in the area of savings. Again, something else that's extremely important, because saving money is a way to plan for emergencies and plan for future goals. Again, being in banking as long as I've dealt with, especially working in inner city branches for as long as I have, I've talked to people who are caught up in cash advance places and paying high fees there and all these things. And, I counsel them on learning to save money And saving money doesn't mean you start with this large goal, because that often doesn't work, because the first time you can't meet that goal, then you stop altogether. You start small and then you increase gradually based on your comfort level, even if it's like $5 per paycheck. You start there and do that consistently, something that you don't touch, and you increase it little by little over time. And then eventually you get to the point where you can borrow from yourself if an emergency comes up, without having to, again, turn to cash advance places or desperate means. So I'm going to have you to turn to the next slide, and I'm going to now turn it over to my colleague, Jamel Parks. At the end of the presentation, I will list my contact information inside the chat function if you want to reach out to me, and we can talk about ways that I can be of service to you. So I thank you for your time. Jamel, you are up.
All right, thank you, Reginald. I really appreciate it. Hello, everyone. Hopefully everyone hear me?
Yes, absolutely.
Okay, all right. So, so the next part of our presentation, I'll just talk about protection and growth, dealing with finances. So I'm very big on quotes. So one of the quotes dealing with protection is, it deals with the time to repair the roof is when the sun is shining. So as far as protecting your home, the roof protects your home, so you must protect your finances. And you don't start when you're under attack. You start preparing for if something was to happen. So now that you have your financial plan in place, which Reginald went over in detail, you need to take steps to protect your finances. So 3 ways that we're going to talk about how to do that is you can protect yourself and your family by maintaining your credit worthiness, guarding against identity theft, and maintaining appropriate insurance levels to protect you and your family. So you can go to the next slide. So I know Ms. James went over this portion in regards to your credit score. So one of the things, I was a credit counselor for several years before coming to Fifth Third. So one of the things I always try to inform people that I sit with, because I've helped a lot of people go from either not having a score to the A range, or having a good score in the 700s, or people that have had, having below 600 scores to getting back into a good range. So I help a lot of people do that. But the main thing is that you should know your score before anybody else pulls your credit. And don't fear knowing that information. Those are the 2 things that I try to stress upon people, because the people that I sit with, they have a fear of saying like, hey, I don't want to look at it. I'm intimidated by it. I don't want to know. But by knowing, you can take the necessary steps to make change. So I encourage everyone to try to get that information. And then once you know that information, you will know whether something is in error. You can also view your account, your credit report, as much as you like. I feel like that from the people that I have spoke with on a consistent basis across the spectrum, think that you'll be penalized by you viewing your own information. That is a falsehood. You can view your information as much as you want. I encourage people to, there's a lot of free services out there. I know Fifth Third has its own service as well, but I just encourage people to look at those services like Credit Karma, so that way you can see what your credit report is. Some of the credit scoring models are estimates, so I try to inform people that that just because you see a credit score doesn't mean that's your exact credit score, because it's a credit score is only good that for that time period, so it can change the next day, and depending on what information in your credit report has changed. So that's one way to protect yourself, is like I said, by looking at it, reviewing your information. Many rates are determined not only by your actual number on the credit scoring spectrum, but what your credit score likely means about your ability to repay your debt. That's basically what the credit scoring model is about. It's about how businesses can interpret whether your ability to repay is high or low. I've been an underwriter before as well, where underwriters just look at the numbers and crunch, make an analysis on whether you are a good fit for repayment. So the loan officer takes that information to determine the risk and the appropriate rate for a loan to that borrower. So a person that's in the higher credit scoring spectrum will have a lower interest rate than a person that is on the lower spectrum, or may not get approved at all if you're in that lower spectrum. You can move to the next slide. I know Ms. James already went over this portion as well. The big thing about this is that what's in your score. So the main thing I try to inform people of dealing with this is that the biggest portions of the credit scoring model is the credit utilization and your payment history, which are, I always say, these are controllable aspects of your credit, especially the credit utilization part. I know that Ms. James talked about the 30% threshold and how you gain points by doing that. One of the things I always try to inform people is that basically the more conservative you are with your credit, especially with credit cards, the more points that you get. I try to, figure out simpler ways to simplify somewhat of a confusing topic. So one thing that I encourage people is not to probably get like under 10%. I know that 30% is a good number as far as utilization, but you even get more points from my learnings that if you're at 10% or less as far as credit utilization. So the main thing is that if you don't have to, a lot of people think that you have to use your credit cards every month in order to get, good credit. That's not necessarily true. You can use it at least every few months to keep it active. But the main thing is making sure that your payments are on time. You keep in low balances, and and making sure that you pay it off in full will be the best situation, but making sure at least the minimum payment is made. I encourage people to at least put auto payment on the minimum payment, because that is the key thing that will prevent any additional fees and any issues from occurring. So, and most institutions will allow for you to make auto pay on your minimum payment. We can go to the next slide. So, as far as protecting your identity, this has been an issue across in the United States and in the world. So, over 14.4 million people have been impacted by fraud. So the main thing that we can do is try to be vigilant in ways that we can protect our identity and put in safeguards. So safeguards would be like alert systems. So a lot of banks, I know Fifth Third has, where you can put fraud alerts up on your account. So if something looks irregular, your bank will notify you immediately, or they may send you a text message saying, did you make this purchase, or did you authorize this purchase? So I encourage that those type of alerts to be set up. You can also set up alerts through on credit cards and on your credit report. The sooner that you are notified that something weird is going on, or then the faster that these things can be resolved, and hopefully no further damage would occur on your accounts. We can move on to the next slide. So are you covered? So one thing that I feel like a lot of families and individuals may not pay attention to is making sure that you have the right insurance coverage. The one way to protect your finances and your loved ones is to make sure that you have the right insurance coverage in case something happens, whether it's homeowners insurance, auto insurance, which most people automatically do, but a lot of people don't take into consideration, what about life insurance, health insurance, disability insurance? So these are very important insurance protections to protect you and your loved ones if something was to happen to you. It says that an annual review of your home insurance, life insurance, and disability coverage are essential to making sure you're adequately covered. Make sure your home insurance provides adequate coverage for content of the home, as well as the structure in case of fire or weather event. So one of the things I would say is that most people just look at how cheap an insurance, how cheap you can get insurance, but you also want to make sure that it's covering the things that are important to you. Also, for life insurance, one of the rules of thumb is that you want to make sure that it covers up to 5 and 10 or 10 years of your salary, so that way your loved ones have resources going back to work, and things of that nature. Also, for disability coverage, most people don't think about this, but disability coverage in most cases happen more frequently than life. You'll need disability insurance more than you'll need life insurance. So many people overlook this type of insurance, but you are actually statistically 8 times more likely to be disabled than to pass away if you are involved in an accident. So you want to have that insurance. As soon as adequate insurance as well. Then we can move on to the next slide. So in this portion is dealing with grow. Basically, we're talking about investments and savings and what are the best practices in order to have your money grow and work for you kind of while you're sleeping. One of the quotes that I look at that I live by is small steps can help you achieve big dreams. Another quote is it's only after you've stepped outside your comfort zone that you can begin to change, grow, and transform. So this area can be, you have to kind of take those small steps so that way you can see the growth that a lot of times you won't see that full growth or full potential or transformation for a while. So, but keep on taking those steps and you'll see in the end that it was worth it. We can go to the next slide. So this one I'm kind of go speed through a little bit. If you have questions, I'll answer them in the Q&A. The financial roadmap is where you decide the course of action you will take to meet your goals for the future. So as Reginald said, you want to write things down, and so that way you can hold yourself accountable. Many goals have a fixed point in time based on things like your retirement age, how long before your child will be in college, and you want to look at short-term and long-term goals. We can move on to the next slide. Once you have written down your goals, you want to check in and look at your goals every few months, or at least twice a year, or at least at worst case annually. And then if you need to readjust those goals, sit down with a professional. I always encourage people to sit down with a professional, especially dealing with investments and savings. So that way they can assist you because there's a lot of computer programs and models to help you readjust to help you achieve your goals. We can continue on to the next one. This one just reiterates short-term and long-term goals. We go to the next slide. This is just a model where you can shows after $10 of savings can happen in a 10-year time period. So it doesn't take much to save in order for you to achieve your goal. You can go to the next slide. This one just shows what happens with $10 a week in savings for a 20-year goal, and then the last one. It just talks about how basically we can, if you focus on your savings, 3 things that I just want to leave with you as far as investment tips: be reasonable in your expectations, speak with a professional, look for additional ways to contribute more to your investment goals and savings goals, and start small if that is what is possible. So you don't always, it's better to start small and then contribute more at maybe at the end of the month than to overextend yourself. So thank you very much. I really do appreciate the opportunity to speak with everyone this evening.
All right. Thank you very much to our three speakers. And we're going to go over into the question and answer section. So if you haven't already, please put your questions in the chat. And the very first question we have is for Janice. And it says, if I have a dispute, if I have to dispute an incorrect collection item on my report, 2 companies removed it, but 1 didn't. Should I submit a follow-up suit letter or a follow-up letter to them?
Oftentimes, it'll take multiple rounds of disputes to get things off. They don't always come off the first or second time. So definitely dispute it again and send another letter disputing it.
Thank you. The second question for Janice is, do you recommend pulling a credit report annually?
Absolutely. You can get one at freecreditreport.www.annualcreditreport.com or www.freecreditreport.com. Definitely, you can look at it more than just one time a year. Your credit report is yours, and you can access it at any time to look at it and make sure you haven't been a victim of identity theft and what have you. But if you're not pulling it every few months, definitely pull it once a year. So the more you look at it, the better.
And then I believe this next one is either for Reginald, Gilson, or for Jamel. It says, once a credit card is paid off, how long does it take to increase your credit score? I recently paid my credit cards off and did not see a change in my score.
I can take,
I was about to say, you can follow up with me, Ms. James. Usually it takes about a month or two from after you make a payment for you to see a difference on your credit reporting for your credit score. Unless, Ms. James, do you have a different perspective on that one?
No, I know that the credit companies report once a month. So depending on when she paid her bill off in full or when she made payments on it will determine if it reported that month. But if it didn't report that month, it'll definitely report the next month. So she should definitely start seeing increases in her credit report within like a month or two, like you stated.
Okay. And then I believe this one again is for either Jamel or Reginald. But Kanise, if you have something you'd like to add, you're more than welcome to do so. It says, I do good savings for a period of time, which most of us do for a period. My problem is going into my savings for items because there is because I have a savings versus a separate savings. I'm considering a trust. What are your thoughts?
I could take that one if you like. So,
Sure.
so really, Miss Payne, this also kind of ties into the importance of having a budget, because with the budget, if you're listing out all of your, like where your money goes and what you're planning on doing with your money for the month, there really shouldn't be a need for you to go into your savings unless it is for an emergency. Sorry, there's no to see my face. Here I am. So there, that's what I would say is that it'll be important for you to start with a budget. That way you can outline what your plan for your money is each month, and then make sure that, so that way you can make sure that the money you're putting aside for savings is something that you don't touch unless it is for emergency purposes. It's also a good idea to, like you kind of mentioned, having separate savings accounts. You can have as many as you want, even having one that has, that's designated for emergencies, and if you want to have another one that's for a goal or a trip or something that you have coming up, and even having more than one account. I recommend that too, because, the way I have mine set up is that I have one account that's strictly for my spending. And at the beginning of the month, I load whatever amount I'm going to spend on whatever I can use. I put it in that, and once it's gone, it's gone. And so, I leave my savings as is. So really, it starts with with being disciplined. A trust, does serve its purposes. I'm just not really sure if it would suit what you're looking for. Again, you want to, just do a better job of budgeting, so that way what you put aside for savings can stay in a savings account for emergencies. So I certainly hope that answers your question. But again, my information is listed if you'd like to talk through this a little bit further.
And then the very last question, is it good or bad to have open lines of credit with no balance? And any of you can take that one.
I guess I'll start, and of course, Kanise and Jamel, you can chime in. I guess it depends on what your overall credit situation is. If you're in a beginning stage of credit building or establishing credit, my view would, again, it varies from person to person, but my view is that you do want to use it, but the ideal is that you want to have small balances along with on-time payments, because you're trying to establish a credit track record, a credit history. If your credit is established, then there's nothing wrong with it, because one of the items that does contribute to your credit score number is how much available credit you have versus how much you use. So if you have credit cards that are paid off, that's good. The issue is that you do want to occasionally use them, because credit card issuers, if they see that you're not using the card at all, then they'll close them on you, and which will affect your credit temporarily. So if you have something you don't use, I make it a point, I have it scheduled that for certain credit cards, I use them once a year for a small purchase and pay them off again, just so that I'm not losing that available credit. So that's my take. Kanise or Jamel, maybe you want to add something to it?
Well,
Go ahead.
Ladies first. Yeah.
So personally, I have, like, over the past 2 years, was working on becoming debt free. And so what I have done is I have, most of my cards are zero balances, but every now and then I do swipe it just so there is some form of activity on the card. So for an example, I've had a gas card for years. Every now and then I'll just get some gas, but I pay it before the interest accrues on it. So it's not like I'm, paying interest. So definitely use your cards. It's very good to keep them active, but just don't put high balances on them. So you definitely need to use those cards every now and then to show activity and a positive payment history.
And I know one thing so as far as keeping a balance from month to month, like I said, you don't pay any interest on the credit balance as long as you pay it by the due date. So I definitely encourage that, so that way you're not paying institution unnecessarily. But from my experience dealing with people, that you can make a transaction and then pay it off before the due date as well. So that way it still shows activity on the card, so institutions won't close it out. But at least, and then you don't have to worry about, weather being late and things of that nature. So, it's up to you how you want to proceed, but I just encourage people to be as conservative as possible with those credit cards.
Thank you very much. And for those that may have joined after the presentation started, the presentation is being recorded, and so it will be available for your review. You may have a copy of it after the presentation has concluded. And if you haven't already, I would ask our speakers that did a phenomenal job to make sure that you put your contact information in the chat so we can share it with the participants if they need to follow up with you in regards to a specific banking issue. Thank you very much. And I'm going to turn it back over to, I believe, Jill.
Really quick before Jill comes back, we know we have some participants, some attendees that need to step away, and we want to make sure that we give you all an opportunity to give us some feedback on today's presentation. So we are going to put the link for the survey for this event in the chat. We just ask that you all take a moment sometime between now and it will be posted until the 9th of March. If you all will give us some feedback to let us know how we did today, how our panelists did, as well as what information you'd like to see going forward. And that information is now in the chat, and we just ask that you take a moment to click on that link once we're done with today's presentation.
Thank you. That was wonderful information and lots of great questions. If you think of anything else, absolutely feel free to drop some more questions in the chat and we'll make sure to address them all today. So I'm actually going to turn the next segment over to Shanna, and she will introduce our fraud prevention. Yeah.
Thank you, Jill. I am Shanna Young. I am a member of the Torch of Wisdom Foundation Economic Education Steering Committee team, and I am here to present to you our segment 2 presenters. One moment. And segment 2 is our fraud prevention segment. And I present to you Laura Blankenship of the Better Business Bureau. Laura Blankenship joined the Better Business Bureau serving Eastern Michigan and the Upper Peninsula in 2017. Ms. Blankenship is responsible for overseeing day-to-day communications and marketing for the Better Business Bureau, including community activities, media relations, website and social media management, etc. She earned both her Bachelor of Arts and Master of Arts in Journalism from Marshall University in Huntington, West Virginia. Ms. Blankenship has a passion for working in the nonprofit community. She was on the board of directors for the Children's Therapy Clinic, communications chair for Generation Charleston, and an active member of the Kiwanis Charleston Humane Association's Communications Committee. Without further ado, I give you Ms. Laura Blankenship.
Hello, and thank you for having me this evening. Today, we're going to talk about fighting financial fraud and the red flags of fraud. Let me share my screen. So scams have a $50 billion impact to our marketplace each year. Some of the biggest investment scams have had huge impacts, such as if you remember the Bernie Madoff and his $20 billion Ponzi scheme. Scammers are very creative and they stay on top of hot trends to know what's current and where people may be vulnerable. So the impact, unfortunately, 1 in 5 will lose money each year, but significantly less report it. So research shows that more than 8 in 10 are solicited for scams each year, and 1 in 5 will lose money. However, many don't report their loss to BBB or to the FTC. In Michigan alone last year, there was almost $200,000 in investment fraud that was reported to Better Business Bureau alone. So our BBB scam tracker data shows that investment scams are a top risky scam each year, with it being number 2 in 2017, number 8 in both 2018 and 2019. And we have not released our data for 2020 yet, but we will be doing so in the next month. But it is projected that it will still remain one of the highest, riskiest scams. This is because those who were targeted were very likely to lose money. More than 1 in 2 people who reported a scam to our scam tracker or to the Federal Trade Commission said they suffered a loss. You may hear other types of scams like the grandparent scam or home improvement. And here recently, we see an increase in COVID scams. These are mentioned more frequently, but that makes it even more important to learn about investment scams because the median loss in the BBB Scam Tracker Risk Report was over $2,500 last year, so for 2019. And the FTC reported that $108.5 million were lost last year alone to investment scammers. So what are the risk factors here? A lot of people seem to think that if you don't have a college education or if you're younger, you're more likely to be a victim of these scams. Well, younger consumers are more likely to fall victim, but it's actually older consumers who are college educated who lose more money. So some key risk factors are financial instability or feeling the need to catch up. Feelings of isolation or loneliness can contribute to being a victim. It's very important not to let your scammer isolate you. So reach out to a friend or a neighbor if something feels off. BBB for a second opinion before engaging with what could be a scam. And then also another key risk factor would be not knowing about scams or fraud tactics. So it's very important to make sure that you educate yourself. And as the other presenter said, it's important to know what's out there. So look for the red flags. Something that you should look for is phantom riches. So a phantom is something that you want but can't have. And if it sounds too good to be true, it probably isn't real. So what is the salesperson really saying? Are they dangling incredible returns, guarantees, or even risk-free investing? Are they saying that the investment itself will lead to a different and much better lifestyle? Also, they often source credibility. So we all want to speak to someone who is licensed or seems credible, but anyone can put on a suit or rent a nice office. So you have to make sure that they are credible. And that kind of goes with checking the reviews, checking any complaints. So you can definitely check them out at bbb.org. You want to make sure that you do your research and be aware of how the surroundings influence credibility. Because unfortunately, anyone can say they're someone that they're not. So one way that you can do that is you can actually go to the FINRA broker check, and you can search the name and find out whether or not it's actually a credible broker. And it's really important, again, to do your research. You can check their background and their registration there as well. FINRA.org also provides a tool to help you better understand the alphabet soup of letters beside of a person's name. So you can source their credibility here. You can check the designations database to see what the letters stand for, who the issue organization is, what the experience or educational requirements are, and whether there is a complaint or disciplinary process that is available. You can also see whether the designation is accredited by anyone. So preventing fraud, you need to avoid it and say no. So don't pick up the phone for a number that you don't know. Register your number with the National Call Registry and never rush to a decision. Be ready to say no to a fraudster. If you hear an offer that is too good to be true, Or they say everyone is hopping on this investment opportunity. They may even say, join us and receive a free lunch, or act now, the offer is going fast. These are all tactics to get you to act quickly. If you feel uncomfortable, just say no. If it's a legitimate business, then you can go back. You can always change your mind and go back and do business with them. But never feel pressured to act quickly. So ask and check the registration status. And ask if they are licensed to sell the investment and if the product is registered. Check that they are licensed using FINRA broker check. You can find that at www.finra.org/brokercheck. And check that the product is registered with the SEC. You can do that at www.investor.gov. So where to check? There's multiple websites that you can check whether or not they're accredited, whether or not they're credible, any information about them, whether or not they're registered. So the investment professional and products, you can check state securities regulators, the North American Securities Administrators Association, that's NASAA.org. That you can check investment advisor firm and products with the U.S. Securities and Exchange Commission, so the SEC, and you can do that at sec.gov or investor.gov. To check out brokers, again, FINRA Broker Check. That is a very useful site. You can just check that at finra.org. And to check out insurance agents, you can do that by going to the NAIC. And again, that is just nac.org. So before you invest, ask and check. That is the best thing that you can do. Always do your research. We have tons of information at bbb.org. We have fighting financial fraud and workshops throughout the year that we host. So you can look us up. Our contact information is again bbb.org, or you can give us a call, and I'm going to give Shanna that information. But if you do have a pen and paper ready, it is 866-788-5706. Again, that's 866-788-5706. I'm sorry that we don't have that slide up, but that can give you just a little bit more information. You can give us a call or email us anytime if you're wanting to participate in one of those workshops. So thank you for having us today. We appreciate it. And again, you can always check out bbb.org. If you want to check out whether or not there's investment scams in your community, you can actually check that at bbb.org/scam tracker. Thank you.
Thank you so much, Laura, for that information. Great presentation. So we do have a few questions for you in regards to the information that you provided. So the first question is, how helpful are programs such as LifeLock in regards to preventing identity theft?
So those programs are very helpful. You should absolutely, especially if you think that you've been compromised, you should absolutely enroll yourself in those programs. You should also put, if you think that you've been compromised, you should put an alert with the credit bureaus as well. There's a difference between a fraud alert and putting a lock on your account. A fraud alert lets them know that you may have been a victim of a compromise or possible identity theft. So they have to check for multiple avenues before actually issuing credit. So we always say, if you're unsure, just put an alert out there.
Great, thank you. Another question for you is there a way for consumers to protect their minors' credit? from, or put fraud prevention measures on for their minors, or is that even necessary?
That's a great question, because unfortunately scammers will use minors' information to open lines of credit as well. So the best thing that you can do is protect the minor's information, especially whenever it comes to anything online. So do not enter their social security number, even their date of birth or personal information online. It actually goes as far as being very cautious to post personal information on social media, because hackers are very savvy. So while the security measures that social media have up are very helpful, it's not foolproof. So be very careful with first what you're putting out there. And then again, if you are suspicious, if a letter comes to the mail or comes through the mail in the minor's name, then you can put an alert on their account as well, or you can put a freeze, because they're not going to need to open lines of credit unless they're approaching the age to where they would need a line of credit. But I would definitely suggest putting a freeze on their accounts then.
Okay, thank you. Another question for you is, how often do people tend to recoup lost finances due to fraud?
So, really, it just depends. As I said before, it's one of the most common scams for people that lose money. So unfortunately, because they are fishing for more money and larger sums of money, it can really hurt someone and hurt their bank account. So we see a lot of people who are trying very desperately to get their money back once they've already lost it. And unfortunately, it's almost impossible. And then, they're trying to restore their credit. And it's very difficult for them to do so. That's why we are always talking about fraud prevention, because that's the best way to protect yourself.
Great, thank you so much. So those were the questions that we had for you this evening. We appreciate you taking time out, as well as to our other panelists this evening. And so once again, we do have the QR code for those of us that are still present in this meeting to take an opportunity to take the survey. All you do is take a picture of the QR code or hold your cell phone in camera mode up to the QR code, and it should take you right to the survey that way. Once again, if you are having, if you have issues with getting to the survey that way, you can also take the survey at deltasac.org/feedback. That will take you to the survey as well. The survey will be posted until March 9th. However, if you could take that as soon as possible, we would greatly appreciate your feedback. So as we come to the close of our evening, I'd like to bring forth Tanya Rose from Fifth Third Bank, followed by our Delta SAC president, our Southfield Alumnae chapter president, Kimberly Owens Calloway, to give us closing remarks for the night.
Well, hello, everyone, and I am absolutely honored to be here tonight and to actually be able to wear two hats. I am the Community and Economic Development Manager for Southeast Michigan for Fifth Third Bank and Vice President. And I'm also a member of the Economic Development Committee for the Torch of Wisdom and a very, very proud member of Delta Sigma Theta Incorporated. That we are going into our third year at Fifth Third Bank with collaborating with the Torch of Wisdom on some phenomenal educational programs. And we are super excited to continue that programming throughout this year. So please stay tuned and continue to review the website for upcoming programs that we will be having with the Torch. And again, we're honored to continue the partnership. And I am going to turn it over to the Delta Sigma Theta president, Kimberly Owens Calloway. Thank you.
Thank you, Tanya. Good evening again. I am Kimberly Owens Calloway, the president of the Southfield Alumni chapter of Delta Sigma Theta Sorority Incorporated. And I want to thank you all for joining us this evening. I believe that it has been time well spent. We have been thoroughly informed on how to navigate our way to financial freedom and debt reduction. Excellent information was shared by all of our panelists, and we want to thank them again for their wealth of information shared, their time after working a full day of work, and support of our economic educational series. Thank you again, Kanise James from Kingdom Financial, Reginald Gilson, and Jamel Parks of Fifth Third Bank, and Laura Blankenship from Better Business Bureau. We appreciate you and your commitment to financial literacy. As stated before, the Economic Educational Steering Committee is a collaborative effort between the Church of Wisdom, Fifth Third Bank, and the Southfield Alumni chapter of Delta Sigma Theta. I am also very proud of the information that we are able to provide to the community. And we just, again, invite you to stay tuned because this is a series of presentations or webinars that will bring you very informative information. So we hope to see you there. Thanks for joining us and have a wonderful rest of your evening.
Bye-bye, everybody.
Good night.